think we all agree that one of the most relevant features of the post-crisis regard to reform is the establishment of a new resolution framework. I think the objectives are quite clear. It's about actually trying to minimize the financial stability and broad economic impact of the failure of systemic institutions by preserving their critical functions with little or no, if possible, involvement of taxpayers' money. The framework more or less basically encompasses three types of elements. First is some provisions to ensure, to facilitate the resolvability of systemic financial institutions. Second, so some policy tools, some powers for administrative authorities that could adopt measures that could provide sort of a credible alternatives to public ownership or bailouts of financial institutions that are non-viable. A third element is some limitations and sort of restrictions for the use of public funds in resolution. The new framework has been adopted by a number of jurisdictions, particularly those which are home of global systemically important banks, G-SIBs. Moreover, in some jurisdictions, notably in the European Union, the new resolution framework is also applied to a larger population of banks whose failure in principle is considered to be systemic or is considered to meet the public interest criteria. However, the adoption of the new framework, as specified in the FSB's key attributes for effective resolution, is far from complete. If we look at the report published last July by the FSB, the so-called FSB Progress Resolution report, this indicates that although almost G-SIB host home jurisdiction and key host jurisdictions have in place comprehensive resolution framework, the adoption of the key attributes as such is not yet complete, it's not fully satisfactory. For example, more than half of the FSB jurisdictions do not have in place yet bail-in powers. And 1/3 of those FSB jurisdictions cannot actually establish bridge banks. And of course, some progress is going on in relation to these deficiencies. We will also discuss later, but it seems to be the case as well, that the progress in non-G20 or non-FSB jurisdictions in relation to improving their resolution frameworks is not fully satisfactory. So basically, there is no much action or no sufficient action in those jurisdictions which are not members of the FSB. In addition, and you know this well, the experience so far points also to relevant practical implementation challenges of the new resolution framework, even in jurisdictions that have adopted basically all key attributes. And this is an area in which, of course, the FSI is now working, is now paying attention to. We believe this is something that, of course, may actually have serious policy implications in the years to come. Those challenges seem to be particularly relevant for the application of bail-in tool to banks which follow a traditional business model, basically banks which are financed exclusively by capital and deposits. We have found in that regard that there could be often scope to consider, in parallel to the adoption of the resolution framework for large systemically important institutions, an improvement of the insolvency regimes to be applied to small and medium-sized institutions, banks for which both the standard court-based liquidation procedures and the new resolution framework can be equally unsuitable. Finally, in spite of extensive progress made to date, it seems that much work is still required, actually, to ensure adequate functioning of the cross-border resolution arrangements. In that vein, probably it's important to ensure an adequate functioning of the contractual and statutory arrangements in relation to the recognition of bail-in actions in foreign jurisdictions, but also the adequate functioning of the internal TLAC structures that underpin group resolution strategies, And also it's very important in that regard, of course, the adequate functioning of the crisis management groups. So it then looks that while progress has been made, that's for sure, we'll for sure confirm that after our conversation today. It's clear that some work still needs to be done. There are some challenges which are still quite relevant to ensure an adequate functioning of the new resolution framework. But fortunately, as Juan Carlos said before, we have a highly distinguished set of speakers to deal with these matters. In order to kick off the debate, I will put a relatively general question now to the panelists, and then we'll get to more specific issues. So my first question will be, actually, what's your general assessment of the functioning of the new resolution framework, and in particular, whether you feel that, well, the new resolution framework was able to meet the declared objective, basically to try to solve the too big to fail problem. So, you want something more specific, it would be nice if you could actually tell us where do you see the main implementation challenges, both in advanced economies and emerging market economies. So I think it would be a good idea just to start with Mark. Mark, you are the standard setter here, so you have obviously a very good position to tell us what is your assessment of how the new resolution framework is actually functioning, what are the main implementation challenges, to which extent we are close to meeting this objective of minimizing the too big to fail problem. Thank you.
Okay. Many thanks, Fernando. And I think that's it's obviously a very broad question, and I try and decompose it a little bit and give you a sort of high-level view, and we can delve later certainly into the details. I think the tenor of your remarks suggests that the most interest lies on the side of the banking industry, but and I noted the title of your conference is a cross-sectoral look at the world as it is today, and so maybe just a quick point about the various subsectors of the financial industry in comparison. And I think it is true that we've made by far the most effort on the banking side, and we've come the furthest, and I'll drill a little bit into that afterwards, because I think that's where there's the most to discuss. If we're honest, on the insurance side, we've spent years coming to the point where we have found it difficult to reach consensus on what is systemic risk in the insurance sector, and are in the middle of changing the approach away from the identification of systemically relevant institutions to at least a complementary approach to identify the activities. So, there I would say progress has been extremely limited, but you can debate what the level of systemic risk from this sector is in the first place when it's focused on its core insurance product. There is a theme which is extremely important, and it's also important to the banking industry, which is probably in a way underplayed, because we always love to talk about the banking sector, but that's the theme of CCP resilience, and there I would put recovery and resolution almost together, but we can park that and discuss it later. But just to place the question, the post-crisis reforms made CCPs massively more important to the financial system than they were beforehand. That was deliberate and intentional, but it is, for me, a very open question as to whether we have CCPs with the resilience that we need if they were to run into difficulty, and the work on answering that question, and if the question is no, they're not resilient enough, doing something about it is really at a very early stage. So I think it's okay that you've started with banks, maybe looked at insurance and not got very far, and then coming to CCPs as they have evolved in their roles, but we shouldn't forget that they are very important systemic nodes. I think on the banking side, we've come an awfully long way. That we should never forget, because it's my role and as a supervisor and a resolution authority head always to look at what we haven't yet accomplished. But the banking landscape is much more resolvable than it was 10 years ago, and masses has been done and been invested to get us there. At the same time, I think we are a long way from being able to declare victory or to say that we're satisfied with the status that we have today. That's why the report that you cited in your remarks from the resolution steering group last year had the title "Keeping the Pressure Up," because 10 years after the crisis, or more than 10 years now, there's a fatigue that sets in, like when you're over kilometer 30 in a marathon. At kilometer 40 in a marathon, you know the end's in sight. Around kilometer 30, it hurts, but you're not there yet. And I think that's about where we are probably. We've got fatigue. We know there's a long way still to go. We've accomplished more than probably half of what we need to do, but there's still a lot to be done. The market recognizes progress. The market has reduced the level of acknowledgement of state support in the rating of large banking groups over time. So the market, this sort of too big to fail premium or in funding costs has been reduced over the past years, and they acknowledged the structural changes and the volume of loss absorbing capacity that has been built up over these years, which is very substantial. So we are on the right track still, but not everything's been done. We are talking about, on the banking side, largely implementation issues, not so many policy issues, certainly at the international level, that are open, but it's about getting things implemented in statute, and then it's getting things implemented within the banking groups to make them fit for a potential resolution. And I would name two challenges which are particularly thorny and taking up a lot of attention is the distribution of loss absorbing capacity within a group. For those in the know, that's ITLAC, internal total loss absorbing capacity, how we distribute that between geographies and entities. And the second is funding in resolution, how we provide liquidity for that spike in funding needs that most of us expect will be there within a resolution process. Those are the two biggest implementation issues we face, and the biggest challenge that is yet to be faced, for good and for good reasons and reasons we should be grateful for, is the practical test of putting some of these tools into application. And we've got there are then two questions: will it work operationally, legally, as we've set it out to do? When we take a big institution and the resolution of one of those institutions, and the second is, have we got the political will to get it done? And I think there we have to say we've seen sort of some relatively sobering dry runs on smaller institutions on the European continent, where you'd have to say, well, if we're not brave enough to test it there, are we going to be brave enough to test it when it comes to a really big animal, right? So there are some, from my perspective, relatively dubious pieces of evidence as to whether we have the political will to execute and really keep the taxpayer out of resolution, because there's a lot of counter evidence being built up at the moment. So I'll leave it there.
Thank you very much, Mark. Of course, we all in this room know how you feel when you are in kilometer 30 of a marathon. That's a very clear example. Yeah. Thank you for that. Okay, second speaker is José Manuel Campa. Again, thank you very much, actually, for participating in this panel with such a short notice. But at the same time, it's quite fortunate, because you're in a very unique position in your basically transition, sort of to become a high relevant public sector official in the European organization, leaving actually a global systemically important institution which was actually involved in the resolution action as an acquirer of a significant institution in the banking union. So I think you have actually extremely good position to discuss these matters from a different perspective. So that's my question. How's your experience? What your analysis actually tell you about actually the functioning of the resolution framework and the main implementation challenges that we have to face right now?
Thank you. Thank you, Fernando, for giving me the opportunity to be here. As you say, I'm in a special transition point, so I should put a disclaimer to everything I say because I'm leaving the bank and I have not joined the ABA yet. So everything I say should be my remarks, and they neither reflect the views of Banco Santander nor of the ABA at this stage. So it's my own, it's coming back to my academic past in that sense, I speak only for my own. But having said that, congratulations to the FSI on your anniversary. I must admit I came many times to Basel. I never saw so much activity, so much festival activity as I saw Monday night. I thought, wow, the FSI really has power in Basel. Then I realized it was something else. It was just correlation, but no causality here. Anyway, coming back to the issue of the roundtable, I think I very much agree with what Mark said, and I think the underlying thing that's going on so far is work in progress. It's work in progress. It's huge amount of progress that has been made from what I would call a very low starting point. When we think about here that we're in Basel about prudential regulation and Basel I, Basel II, Basel III, there's a long history of all of that. And nevertheless, the crisis was very harsh on that part of the regulation as well. When we think about resolution, it was almost non-existent prior to the crisis. So we're building from almost zero. And I think the progress has been very high. If I have to make the comparison, I would say the glass is clearly half full or more, as we said, maybe 70% full. But it's not 100% full. And you always have a problem of committing type 1 and type 2 errors, focusing too much on the wrong people and maybe not focusing enough on other people. And I'll make my remarks a little bit on that aspect. The first thing I like to put on the table is that, and this has been already discussed implicitly by the remarks of Fernando and Mark, is there are two goals in mind. One is financial stability, and the other one is no use of taxpayer money, or very limited use of taxpayer money. And that's not necessarily the case across the board. The FSB is not 100% committed to that point, but that has become very important in many jurisdictions, and particularly in Europe. And those two issues sometimes may be at odds, maybe in contradiction with each other. You can preserve financial stability maybe by using a lot of taxpayer money. And by not using taxpayer money, in some cases, may you actually be in a situation in which you are at risk of preserving financial stability. And I think that's going to be one of the big tests as we test the system. What's going to prevail? What's going to prevail? And I think that within the insiders of the banking world, financial stability tends to be more important than the use of taxpayer money. Certainly has been in historical standards, When you look at society at large, certainly the use of taxpayer money has become more and more tangible. I don't know if more important, but more and more tangible than this concept of what's financial stability or what's financial instability. And that's going to be a big challenge. When you say about the political challenge of facing an actual resolution, I think that's going to be, that trade-off is going to be very, very important. And we see some of that already in some of the European cases that I'm sure will be brought up. Now, what are the things that I think are pending? Well, there's the real test, trying to resolve an institution that's systemic, and we have not been confronted with that. We've been preparing for that. I like to do the analogy. This is like a little bit of, if we were a convention here of defense officials around the world, 10 years after World War II, talking about the use of nuclear weapons. So it's like we don't want to use them. We have to manage them. We have to try to avoid that they're being used. They were tested, and we didn't like them. We know that this happened in the crisis with too big to fail institutions, but we have to manage how we're going to be able to do that or not. I think that there are three key points that need to be worked more on, okay? First one is war games, exercises to try to see how this will work in practice, to foster that collaboration, to identify areas where weaknesses may be present. Institutions are doing that themselves, but there needs to be much more done with authorities. And authorities, maybe they're doing it. As far as I know, they're not interacting with institutions if they're doing that, and it's maybe simultaneous testing in different dimensions. But I think that's very important, because the second thing that I think is very important is cross-border collaboration and cross-border issues. One thing that's clear about resolution, we tend to think about systemic issues, but one thing is true, resolution is local. Resolution at the end of the day is dealing with legal claims in a particular entity that's incorporated in a particular country. And that's very, very much yet a local issue. And, just about across the world, insolvency regulations are very local, customer protection, other types of issues are very, very local, and they're very different. And its mandates of resolution authorities and mandates of most authorities continue to be also local. So, it's natural that authorities in the middle of attention will try to stick to their mandate and make sure that they comply with their mandate, and that mandate is fundamentally local, it's not cross-border. And that's a real challenge. I think that's going to be a real challenge. So doing war games and making sure that those war games address directly this issue of how we're going to be managing local resolution of a global institution, regardless, and this, of course, organizational structure of the institutions will differ tremendously. And to what extent this can be applied in a more or less simultaneous way, or in a more or less sum of the parts way, or different approaches will differ. But that's I think at the core of the challenge. Then the second aspect, which I think is important, is institutions, banks, are not used to thinking about resolution. And it's not the first list in the priority. The first list in the priority is obviously being a going concern, being a profitable concern, making risk-adjusted returns that are adequate. It's not thinking about how they're going to be, resolved once they're not able to be viable. So it's difficult to maintain the momentum for the institutions. I think internally it's going to be very difficult for them to maintain that momentum. And that's a challenge that we have out there. Now, the third big issue is the type 2 errors, which already have been mentioned by Mark. I think that we have a big chunk of the financial sector that's outside banks. So somehow we've been able to convince ourselves implicitly that banks are the really systemic institutions, although I suggest that the evidence from the crisis suggests the opposite. But maybe that's up for grabs. AIG was not a particular bank that I know of. The first failures in the US were mainly from asset managers more than banks, although they have some bank components of them. So this is an issue that's on the table. Mark already talked about CCPs, which is clearly one aspect that has to be also on the table and it's not being addressed. So if we're worried about financial stability overall, those players are well identified. Last night we had a very interesting presentation that pointed to other players, which could be also very systemic, and we don't really know anything about them. And maybe we're focusing, as usually happens, on issues from the past or structure from the past and not thinking about the future crisis, and that's a challenge that I think is difficult to address, but at least should be put on the table. Then the final aspect, and maybe we'll come back to this, is this issue of how far we need to go, because we said about too big to fail for financial stability purposes, that's probably the right approach. But when we're thinking about the use of taxpayer money, it's not too big to fail. The crisis showed that in many jurisdictions there was no bank small enough not to be saved. And that's a different criteria. So when you think about taxpayer money, the second criteria may be more important than the too big to fail criteria. Thank you.
Okay, very good. Thank you. Thank you very much. Many questions. I hope that in the second round of comment you will provide us some answers. Now we go to Lynn. Lynn, you represent here non-G20 jurisdiction. I think your perspective is very important to tell us how things have actually changed in those jurisdictions in which they are not in principle committed to the standards actually developed by the FSB on this important matter.
Thank you very much, Fernando, and congratulations to your 20th anniversary. So just to give some context on the challenges I will mention, let me briefly describe the structure of the Philippine banking system. Now, what too big to fail for us are those considered as DSIBs. So a DSIB in our country are domestic banks and foreign banks that could either be GSIBs or non-GSIBs. So the Philippines is not a home jurisdiction to any of the GSIB. Our domestic banks are not internationally active, but we play host to a number of foreign banks that are either GSIBs or large Asian banks. So having said that, I will be discussing 3 implementation challenges and these key attributes. The first one is about the comprehensiveness of the resolution power of domestic authorities. The second one pertains to the level of preparedness of the domestic financial system to support bail-in instruments. And the third one pertains to challenges related to cross-border banks. So Compared to the FSB's attributes, the resolution powers of the Banco Sentral and the Deposit Insurance Corporation are quite limited. Since these are embedded in the law, legislative amendments are necessary to strengthen these powers. The political dimension that goes with the process entails extensive dialogue with the two houses of Congress, with all stakeholders and other government agencies. Some actually fear that giving us this power, we will be perceived as all-powerful, and we will unnecessarily curtail the rights of the stockholders and creditors. So it is important that during these activities or process, we'll be able to explain why the need for these powers, and which is to promote the welfare of the banking industry, and these are all balanced by appropriate standards. For instance, the power to carry on bail-in within a resolution is a resolution power which is new to our local setting. So the preparedness of our domestic financial system to fully support these instruments need to be carefully studied. Bail-in as a resolution tool remains largely untested across the globe. The authority to carry out bail-in is currently not in the power of the Banco Sentral or the PDIC. The BSP, however, allows banks to issue contractual bail-in instruments that count towards their qualifying capital. But 5 years after issuance of that regulations allowing the issuance of said instruments, domestic banks remain reliant on traditional capital instruments to meet their prudential capital requirements. There is little incentive for banks to issue contractual bail-ins. First, their capital adequacy ratios are quite high, way above the 10% minimum prescribed by the Banco Sentral. Second, it's costlier to issue these instruments, a lot costlier than tapping retail deposits or plain vanilla bonds, which they use for funding. And third, another factor that influences this is the level of preparedness or the level of development of the domestic capital market. The fixed income market in the Philippines is largely a government securities market whose investors are mostly banks. So deeper capital markets will allow for a diverse and wider investor base that can mitigate the spillover of a system-wide impact of an activation of a bail-in. The third challenge related to cross-border cooperation. The FSB provides host authorities with enhanced powers related to the recovery and resolution planning of cross-border banks. A substantial amount of work still needs to be done in this space. The BSP is currently not a party to an institution-specific agreement for a GSIB that is operating in the Philippines. Due to practical considerations, there's been very limited opportunity for the Banco Sentral to engage the home jurisdictions in discussions in recovery and resolution planning. These discussions are very important to us because we wanted also to ensure that the strategies that will be embedded are consistent with the national objectives, and they take into account the interests of the banking sector. So those are my thoughts, Fernando. Thank you very much.
Thank you very much. I think it's important that the two ideas you stress the difficulty to implement the bail-in and also the issues relating to cross-border arrangements. Both of them absolutely key on this discussion about implementation challenges. Right, so then I will now give the floor to Arthur. Arthur, of course, works for an extremely important resolution authority with much experience, actually dealing with the crisis of banking institutions since decades ago. I think the FDIC was able actually to resolve like 500 institutions over the crisis, but in principle, all those resolutions were under the FDIC Act, so the previous regime. So how do you see now, basically, the interaction between sort of the old resolution regime and the new resolution regime that you put in place under Title II of Dodd-Frank?
Great, thank you, Fernando. And let me add my congratulations on your 20th anniversary. It's nice that the system is in much better shape than it was on your 10th anniversary, and look forward to seeing what it's like on your 30th. So I'll talk a little bit about the experience in the U.S. since the financial crisis. I think it's well known that in 2008, at least in the U.S. and other places, we lacked the tools necessary to deal with the problems of a financial firm, large financial firm, facing failure. In the U.S., the FDIC had authority to resolve banks with insured deposits, but that was all. No authority to intervene in their parents or their affiliates, and certainly no authority over financial firms not affiliated with banks. And so what that meant in 2008 was that policymakers faced this bad choice that's been mentioned before of allowing a disorderly resolution under the normal bankruptcy code, or on the one hand, and the financial disruption and damage to the real economy, or on the other hand, bailing out the firms and getting the negative reaction from the public. And, in the U.S., we did both. And so the point of Dodd-Frank, or one of the points of Dodd-Frank, was to provide policymakers in the future with a better choices for that. And so the Dodd-Frank put in place a resolution framework in the U.S. that was designed to allow for orderly resolution without taxpayer support. And what that also means is that there would be accountability for the managers, shareholders, and creditors of the firms that got into trouble. And so this framework in Dodd-Frank starts with bankruptcy as the first option, and to facilitate that, it put in place the requirements for resolution plans, and I'll come back to that in a minute. And for those cases where bankruptcy would be viewed as leading to a disorderly resolution, the Dodd-Frank put in place Title II, which gives us orderly liquidation authority as a backup in case bankruptcy is judged not to work. And the OLA authority is very similar to the authorities that we have with respect to insured banks, but there's a key difference. With insured banks, we have a deposit insurance fund that is there to absorb loss. We have no such counterpart under OLA. There's a liquidity facility, the orderly liquidation fund, but that is only for liquidity and not for loss absorption. So on the resolution plans, the firms have to demonstrate that they could be resolved in bankruptcy without disruption to the financial system. And this was quite a challenge, I think, both for the firms and for the authorities. These plans are overseen by the FDIC and the Federal Reserve jointly. And I think it's fair to say at the beginning, we sort of struggled with how to implement this, but I think it's fair to say that we and the firms have made a lot of progress in the recent years. And we early on identified obstacles to orderly resolution and asked the firms to address these obstacles, things like capital and liquidity, counterparty actions, particularly with respect to derivatives, global cooperation, operational continuity. And the firms had to demonstrate in their plans that they could address these. And I think over time, they made a lot of progress. The firms have made changes in the way they operate. As Jose said, the firms don't like to think about their resolution. They don't want to spend time thinking about being measured for their casket and so forth, but they've made some progress. And I think it's fair to say that as a result of the living will process, the way they structure themselves now takes resolution into account. So it's not just for tax purposes or regulatory purposes. Most of the firms have adopted the single point of entry strategy for their resolution strategy. And, that was a strategy that was designed by the regulators and the industry when the new authorities were put in place. And a lot of progress has been made in making single point of entry work, things like loss absorbing capacity and the stays on derivative contracts. And for the U.S., what we call clean holding companies, where the parent company issues long-term debt into the market that will be there to absorb loss, but they do not issue short-term credit that stands side by side, so it facilitates an orderly resolution. There is a connection between the resolution plans and our orderly liquidation authority, and I think it's fair to say that all of the changes that have been made to prepare the firms for bankruptcy would also facilitate resolution under the orderly liquidation authority. There have been some concerns with the orderly liquidation authority. Because it has the orderly liquidation fund, the line of credit with the Treasury, some people are concerned that that may lead to bailouts. The way it's designed to avoid that is that the use of the liquidity facility under Title II is limited to the assets of the estate, of the failed estate. So we have to take the fair value of those assets, and we can borrow up to 90% of that. And so the idea is that any funds that we would borrow under that line of credit would be repaid out of the proceeds from the estate of the failed firm. If we were to misjudge the fair value of those assets and what we realized from the estate was insufficient, we then are required to assess the rest of the financial industry to make up the difference. And we cannot go to the taxpayer to make up that difference. Let me just finish with, one of the most important aspects of the work that we've been doing over the years is the challenge of global cooperation. We've worked with the authorities in the key jurisdictions over the years, and both within the FSB, the crisis management groups, and then bilateral interaction with the key jurisdictions. So happy to talk more about that.
Very good, thank you. Thank you very much. Why don't we just go straight to the first question, to the audience? That's the one. Is the very first issue I raised today. I mean, do you think we have succeeded in ending the too big to fail problem? Okay, there are three options. Let's see if this time, as always, actually we have the middle option to be the one which attracts more support. Indeed, that's the case. That's logical. I think we have to learn for next time. We should have either 2 or 4 options, but never 3, because there is a clear attraction to the middle option. In any case, I think it's quite clear, the result. I think most people believe that although we have made progress, we are still halfway, so there is certainly limited progress and more will have to be done. And this is obviously a very good introduction for the next round of comments, right? So what else should we do? I mean, what type of complementary actions should actually be taken in different domains, actually for the new resolution framework to work properly, or for more generally to have sufficient preparedness actually to deal with a crisis in the future. I don't know, Mark, this may provide you with a good opportunity to talk a little bit more in detail of some of the projects that we are now undertaking in the resolution group of SB, or whatever you feel is relevant for this question.
No, I think clearly that's the key question is how do we shift that graphic of the results and that question to a towards the left, I think it was, right? Because fact is that resolution is also only going to work if people believe it's going to work, because it's going to depend on trust and confidence of market participants and clients at the point of time that you're executing. And if nobody has ex ante trust in the systems that have been built up, the chances of failure are higher. So I think it is a job that we need to do, not only to get the nuts and bolts right, but actually to persuade the people who are going to be stakeholders in a resolution that it will work. And that's one of the pieces of work that we're looking at the moment, is what is the role of disclosure in particular, interesting for me in particular, before a resolution, of regimes of assumed paths to resolution and resolution strategies for institutions, and about creating transparency about what the market can expect. So, because I think there's still outside a sort of hardcore of experts probably too little understanding about how things would work, at least in theory, before we get to the resolution. And I think generally, your question is a little bit, what should policymakers do? I think with the exception of the CCP space, where, as I said at the beginning, I think, we need to take some policy decisions, because I don't think anybody's quite realized how weak CCPs are as institutions, but just do a little research and see what kind of credit ratings the CCPs or their mother companies have. And you'll ask why we made them such systemic nodes in the system. And I realize that that's an oversimplification, because they have very intricate recovery planning protocols. But if you burn through that, there's not a lot left. And we saw the near collapse of a small but systemic CCP in the Nordic region last year, which should be a warning to us that there is a huge model risk underpinning CCP's recovery arrangements, which means that the chance of burning through the protections they have in place is higher than we thought. So my point of view, if you want an area where the policy is not adequate at an international level to give us the security we need, it's CCPs. On the banking side, I don't think it's really a question of international standard setting in the certainly not the big strokes, because I think what we've set out is a framework and a call for action which is relatively clear, which is being implemented. So a huge amount is about getting it implemented and then dealing with the challenges in implementation, which are maybe second order. You know, we're at the moment coming to the conclusion of our review of one part of that framework, which is but a very important part of that framework, which is the TLAC standard. And you know, without wanting to jump to the conclusions of that review, I think it's highly likely that we'll conclude that the standard doesn't really need to be changed or tweaked in any meaningful way. The standard was a good one. The calibration looks good. It's a question about getting it done. And looking maybe at some of the way standards interact with each other and institutions interact with each other. And I think there I'd come back to these core implementation challenges on the banking side, which I mentioned earlier. One is the distribution of resources around the group, José Manuel put his finger right on the point, right? I mean, resolution will, if it leads into insolvency, play out locally, which means that the incentive of a host is determined by their mandate and their legal system, and that can lead to a sort of race to the top effect of you know, creating so much security in each, or trying to create so much security in each local jurisdiction that if you don't increase the capacity at the group level, you've actually decreased the stability of the institution, right? You have that trade-off between home and host jurisdictions, and I think there we're right in the middle of that process for many institutions at the moment, and it's not easy. But I think we have to ask ourselves whether whether we haven't created some incentives for that race to the top in the way the standards have been set with this relatively aggressive range for pre-positioning of internal TLAC up to 90% of what the external requirement would be, and if I understand correctly, the MREL implementation in the EU, where there's also almost an expectation of 100% pre-positioning, and yeah. So the question is, have we got the right balance there between stability in all the individual jurisdictions and the ability for large conglomerates to still continue to play a role? So that's one issue. And the second issue, funding in resolution, has been solved better in some jurisdictions than others. As Art has just articulated the approach under the Orderly Liquidation Authority, which has the benefit of being well known, well articulated, simple and clear. So and I think here, more than anywhere else, we're dealing with with a belief question. And if everybody can see a resolution plan and say, well, that would work if the funding was there to cover a spike in funding needs in resolution, but I don't know where that funding's coming from, then we're in danger of it not working, right? So I think the US have a very clear facility in place. I think the UK with the Bank of England's statements over the course of last year made a very clear statement that there's a kind of whatever it takes in there in resolution. But I think, in particular in continental Europe, and I'd include my own jurisdiction there, we haven't yet come to a clear answer, exactly because of the dilemma that José Manuel mentioned between stability and the role of the taxpayer. And I think the role of the taxpayer, Art articulated it well. There's a kind of fear of getting sucked back into what we experienced 10 years ago, which can extend to the liquidity side. Because the liquidity provision side is seen as a slippery slope to a bailout. And as soon as you say, central banks, state institutions should be there to bridge liquidity issues or the backstop liquidity problems in resolution, there comes immediately the nervousness, well, isn't that exactly what we tried to prevent? But the fact is, if we don't address that, it's from my point of view, a little bit of a fantasy to believe the resolution will run smoothly without some acute spikes in funding needs over that period of time. So you need to say in advance, from my perspective, we'll do whatever it takes, and then you design that in a way that can be very jurisdiction specific, but you need to get a clear design out there in public. And there are many jurisdictions, home jurisdictions of GSIBs who haven't yet articulated that.
So I think going back to your point about the distribution of TLAC resources with the group, of course, this is pretty much related to the issue of SP versus MP, to which extent an SP strategy with 100% pre-location, different jurisdictions, basically yes, is sort of weakening the SP model altogether. I mean, at the end will amount actually to eliminate any flexibility in particular group to distribute resources in the group. This is something unavoidable. At the end, aren't we converging to an MP with different forms for all covered systemic institutions?
Yeah, I think that's the danger is that we start to reduce the benefits of an SPE strategy. But that sounds technical. In the end, what we're doing is we are in danger of disincentivizing global banking, right?
Sure.
If you take that too far, right? Because if you say the TLAC standard is correctly calibrated and is a fair answer to this question about how much loss-absorbing capacity should be privatized ex ante on the balance sheet of large institutions, and if we think that we've got that calibration more or less right, if you're then pushing that calibration significantly higher through the way it's distributed, you are, but you thought you got that burden sharing question right at the beginning, then you're saying, well, I'm happy to tip the burden in a direction which is not constructive for banks active in multiple jurisdictions. Yeah? So I don't think this. I mean, put it another way, I don't think this problem was discussed at the point of originating the standard. And you may have said, well, let's set the standard a little bit lower because we know there'll be a sum of the parts problem, as we call it. So the sum of the parts is greater than the whole, and we'll end up with the same loss-absorbing capacity. But we set the capacity, and then we said we'll find a way of distributing that. And so I think there is a very real tension there at the moment, and I think we do need to find a way of getting back to the concept that if global banks are going to exist, they have to be allowed to have some fungibility in their capital and liquidity resources. Otherwise, in the end, you will take away the reason for them to be global. They have a brand and a management, but they have no fungibility of financial resources. So I think that's the issue.
Trade-off is clear, I think. Yeah. José, you may want actually to discuss, comment on this or other related issues.
Just a couple of related comments. One very much related to this last point. I think that, and it's very appropriate, I think, to make this comment here in Basel. What we're finding out is that there's an inherent tension between prudential regulation and resolution regulation, because prudential regulation has been built on the concept of consolidated accounts, and the bank that's working on the consolidated accounts. And the TLAC requirements were originally thought in terms of those consolidated. But then, as I said before, at the end of the day, resolution is essentially local. So then you go to the core of the deconsolidation aspect of that group and what it looks like when you have to resolve it. And that's where that tension arises, I think. And that's what we're discovering now, is that we've had this tension between, who would be sort of more deconsolidated individual specific regulation for the case of resolution versus a more consolidated for the case of prudential. And that's a challenge that we have, that I think we have going forward. Then the second aspect, which is a little bit related, is that when we talk about resolution, unfortunately, from my perspective, at the end, we always go back to one single number, which is the TLAC number and the amount of available funds. But there's a lot to do and a lot of work that has to be done on the resolvability of the institutions and the way the institutions are managed to enhance that resolvability and the likelihood that an institution large but complex, or large but not complex, or not large but complex, may break in case it needs to be resolved to the financial system. I think that aspect, which of course is much more heterogeneous, involves many other issues, like having critical functions well identified, having continuity plans that are well identified, ability to break the institution by parts or not, what parts could be broken. That part, I think, is something that needs to be highlighted as we go forward. And I like very much the point that you made on disclosure and resolution strategy. What will these institutions look like if they were to be resolved, and why do we think they will look this way versus that way, will give us also an indication about how difficult it will be to resolve them or not. And I think more work needs to be done in that area.
Before I move to this part, you mentioned that how difficult it is actually to convince the bank to devote sufficient resources, basically to prepare the institution for a failure. Now, is there any difference on whether the resolution plan, the living will, is prepared by the banks themselves, or is, like in some jurisdictions, or is rather prepared by the resolution authority, like in other jurisdictions? Do you see any difference there?
No, I think in the end tends to be a semantic difference because the information to prepare a resolution plan is sitting in the banks, and in the end, the ability to declare it plausible is sitting with the authority, and in the end, it's going to be a mixture of the information from the bank and the judgment of the authority. I don't think that makes a huge amount of difference. It can make a tactical difference, right? Because if authorities have the ability to let's say, withhold the approval of resolution plans until they are plausible, that gives a sort of stick to make progress, right? So there are issues about how you get from A to B, but in terms of the way things are generated, I don't think that makes a huge difference. And I think, but just coming back to a point from José Manuel, I think that's it's exactly right. This issue of consolidated or deconsolidated or a solo level. Was never addressed in the prudential standards for banks, and I guess that was because nobody understood how scarce a resource capital actually was, right, when they were designing those standards, and so nobody and so the question was ducked for decades, and that. It is ironic that the first time you addressed that was when you started to talk about loss-absorbing debt capital, which then was expanded to look at TLAC and include the equity stack, or equity as part of the capital stack, whereas the equity capital standards still duck the question, right? Because the issue was always there. The issue, home host and how you distribute capital, was always there for equity capital. It's just the whole standard around defining the quantity of equity capital had, around Basel II had got its calibration fundamentally wrong and was in a massive state of false complacency. We all, the world thought there was adequate capital everywhere before the crisis, right? And it needed this shock to show that the paucity of that argument, it is a little bit ironic and maybe sometimes difficult that this issue's come on the table through the back door, if you like, but it's always been an issue, and I think you can't duck it. You can't just say, the world would be so much simpler if we just went back to a consolidated standard, and we just everybody trusts each other that everything's fungible. We also know that won't work. So the question is just how much safety do you put into the local jurisdictions, and it's not just capital, it's liquidity, where there's a currency angle as well. But when we look at liquidity distribution around global groups where we've got some insight into, you can have liquidity coverage ratios of somewhere, in the 150 to 200% level at the group, but you've got material local entities with over 300, right? So somebody's sitting on that liquidity, and in a crisis, that liquidity is going to need to move to give you a plausible chance of resolving the group, right? And the collateral that's underlying that, right? So trapping a certain amount of resources is rational. Trapping a massive amount of additional resources becomes irrational. That's
Great. Thank you. Thank you very much. So let's move now to Lynn. I think, of course, I pretty much took note of your comments on the difficulties to basically apply bail-in, to the extent it's difficult actually to require banks such as the one prevailing in your jurisdiction to accumulate sufficient bail-inable securities and so on. So, and also the political difficulties you basically raised, which are of course very, very relevant in many jurisdictions. How do you see the way forward there? I mean, what type of actions could actually be taken to?
Problems are quite different from our part of the world.
That's
so,
right.
Yeah. So the political issues surrounding the resolution power that should be embedded in the authority of the Banco Sentral, Deposit Insurance Corporation, it would really help, like for an emerging country like us, if a third-party assessor would come in and point to us the problem that we already know. We could actually use this assessment to lobby for support in Congress to pass a law that would add this resolution tools or power under our charter. So in addition to that, we have to adopt an effective communication plan to bring into the loop the public, other stakeholders on the benefits issues and the mere concept of resolution and how it would benefit the country. So pending this structural change in our national framework, we have taken some initiatives to effectively enhance the resolution regime in the country. The first one is our cooperative or coordination efforts with fellow financial sector supervisors in the country. So this covers information sharing agreement, expectations in times of crisis, as well as manner and modes of communication between and among agencies. We are currently developing a crisis management framework at the national level to ensure that each and every one of the agencies involved have the buy-in to address whatever issues there is that would be put forward, and then to communicate as well emerging issues or threats that they find within their supervisory ambit. We also think that the private sector could play a role in this space. In providing options supportive of best practices in resolution. One example are the industry protocols developed by ISDA on the stay option, in the state provision in the exercise of early termination rights in contracts of certain financial transactions. So I think that these types of contracts would actually help Philippine banks that engage in offshore financial transactions. So those are some of the ideas that we have in terms of this issue.
Thank you. Thank you, Lynn. Now, Arthur, basically the same question. What else would actually be done? Particularly, let me just make a complementary question to you. You mentioned that all this political debate in the U.S. in relation to this liquidity facility that would be available in principle under OLA. Now, what we have seen, of course, is debate raised by the presentation of this legislative proposal for a new insolvency regime for large systemically important institutions, the so-called Chapter 14 type of arrangement. Do you want to comment on this? I mean, what are the implications of this and whatever you feel that would help us in our debate?
Sure. Yeah, I think it's fair to say immediately after Dodd-Frank, there was a lot of tension between the bankruptcy community in the U.S. and the view of the orderly liquidation authority. So I think there was concern that OLA would lack some of the qualities that the bankruptcy process had, such as rights of creditors and so forth. I think we've done a lot of work over the years to dispel some of that, and we've actually worked quite closely with the bankruptcy community in the U.S. to basically to do things to improve the likelihood the bankruptcy would work. We would welcome a new Chapter 14 and improvements in the bankruptcy code so that these firms could be resolved under that. There was, actually a Treasury report last year. The new administration was asked to look at the OLA authority, and they recommended keeping it. And they recommended that we be more transparent about how we would use the orderly liquidation authority, and I think we've been trying to do that. They recommended some improvements to the bankruptcy process, so I think they can coexist. I don't think they're mutually exclusive. So I think that we'll continue to make progress on the bankruptcy front. The firms have done that. We've gotten the firms, at least our GSIBs, they're at a place where, we focused in the resolution planning process on their capabilities, their ability to understand what their needs would be in resolution for both loss-absorbing capacity where it's needed, to Mark's point, liquidity where it's needed. Do they have the systems to be able to understand what those needs would be and how they could get the funding where it needed to be? And so I think we're at the point in the coming years where we'll be testing those capabilities, we and the supervisors of those firms.
If I may here, it's interesting that the situation you have in the US, basically that the FDIC has powers to offer some sort of public support under some conditions, typically to small and medium-sized institutions, not to small and medium-sized institutions, but to the acquirers of failing small and medium-sized institutions. But there is all sort of public facilities that you could help, that could help you actually to deal with the crisis of those banks. Those facilities were actually used up to some point. Afterwards, now I think the latest resolution cases, the FDIC did not use this type of loan loss guarantees or injection of cash to the acquirer and so on. So you see that because of the political debate, sort of all this discussion about the liquidity facility under OLA, the creation of this Chapter 14, all this situation will actually sort of provide obstacles for the FDIC to make use of those instruments in the future?
No, I think you're talking about some of our loss-sharing arrangements, and in a purchase. For the 500 banks that you mentioned that we resolved during the crisis, the typical resolution was a community bank. It wasn't a large bank. We had time to find an acquirer for that bank. We had to do those resolutions under what's known as the least cost resolution. That's we have to choose the resolution that is least costly to the FDIC. We're able to use the deposit insurance fund to absorb the losses in the institution, sell it to the acquirer, and have it continue, open up Monday, business as usual. And to be clear, those losses come out of the deposit insurance fund. That's what the deposit insurance fund is there. It's a prepaid fund there to help us carry out our role as deposit insurer, and it's expected to absorb loss. And there is no controversy about that. And that was a point I tried to make earlier, which is we don't have an equivalent thing under the orderly liquidation authority. We don't have a loss absorbing capacity, and that's a big distinction. But to the point that if you were saying that in some of the later resolutions we didn't use what we call loss sharing arrangements, I think that's because as you get further in the cycle, the firms are more comfortable with sort of what they might be getting in a resolution, and so they're willing to take on a little more risk than they might otherwise do early in the cycle, because early in the cycle there's a lot of uncertainty about how things are going to play out. But I think in the future for community bank resolution, we would probably use the loss sharing tools that we've always used.
Thank you. Any remark before we ask the second question to the audience? Okay, so let's go for it. Okay, very direct question. Do you think that in the next resolution of a large systemically important financial institution will require taxpayers' involvement? Wow. Well, overwhelming majority in favor of thinking that there will be indeed taxpayers' involvement in the resolution of the next large financial crisis. Despite progress made in terms of the development and implementation of a new resolution framework, and in particular, actually, we have seen that it's a sort of much issuance activity, but by GSIBs of bail-inable securities. I mean, still people think that it may not be enough. Can I ask you just to react to this? You feel like, Mark?
Yeah, I guess it's a bet on which jurisdiction the event is going to fall into, right? That's the more interesting question. In which country is the next resolution of a large systemically relevant institution
more
like
direct
to
question.
fall? Yeah, and then you can click on the map, right?
Good idea for the next conference.
Yeah, but I think yeah. Look, we're not done, right? And if you're not done, then the risk of taxpayer loss absorbency, because I think question's also a little bit ambiguous, right? The use of state-backed liquidity facility in a crisis, I would put the probability somewhere near 100%. I just don't believe you can do it without. Or at least, promising in advance that this facility is available, and then maybe you can reduce the probability to some degree. The role of state actors in actually absorbing loss and restoring capital, that's what we're trying to avoid. The liquidity provision we're not trying to avoid per se, but the loss absorbency of a role of taxpayers is what we're trying to avoid. I guess the question is also, how big the crisis is, right? Because, that these TLAC stacks are relatively large in quite some institutions. And, if you have a crisis which may be enough to tip a bank into resolution, but is comfortably absorbable by the loss-absorbing debt being converted, I think your chances are relatively high that we'll get through without it, right? So it's a question of, where does it fall? So how well prepared is that institution, and how well prepared is that country, and the question is the magnitude, also, right? And
is it only the magnitude?
It's not only the magnitude, but it's also
it could be the case also that people believe that while banks can actually accumulate those bail-inable securities, at the end of the day, for whatever reason, the resolution authority is going to refrain from.
Well, that comes back to my first point, right?
Activated.
It's the question of political will, right? And if you don't believe there'll ever be political will, then we're building a kind of very expensive insurance system which is never going to be drawn on, and we're wasting a lot of time and money. In a way, the political it's a political mandate that has led to the creation of this framework, right? The political mandate of the G20 after the crisis being never again, right? And if you say, build me a system that means that will never happen again, and if the system gets built, and if as a politician you then don't want to execute, then it's your own problem. But the lessons learned after that will be pretty severe, right? Because it will be a fundamental question about the ability to run large financial institutions as privatized capitalist institutions, right? Because in the end, if that's the way you're going to do it, then why don't you run nationalized utilities in the first place, rather than pretending that they're private sector institutions that can fail, right? So we are trying to prove that you can run a capitalist private sector financial system, and with all the issues of the social contract that underpins that, and there needing to be therefore a lender of last resort, but the loss absorbency of the failure of these institutions belongs to the people who have funded those institutions, the shareholder and then the creditor, and that's not part of the social contract. Let's see whether we really get there.
Good, thank you. José Manuel, please.
Yeah, it seems to me that the question, it's a little bit phrased in a way that is tricky, because the key point is, what do we consider systemic? And in many ways, in different countries, in different jurisdictions, they're likely to think that things may be systemic because of financial stability, or like we saw in Europe in some of the current cases, because of other issues. Domestic economy stability, unemployment, local impact, things of that sort. What I will think is, despite whether we think that taxpayer money will be needed or not, I would say there are three things that are clear. One is that the willingness of society to use that taxpayer money is lower than it was before. Second, that the amount of bail-inable funds or loss absorbency that will be in the banks is higher than it was before. And third, that all the thought process in making these banks more resolvable and less likely to cause systemic crisis should be there. So all those three things are in place. Whether that will end up at the end with a lot of money being used by taxpayers, my prediction, given these three outcomes, is that it will be less than it would have otherwise been in 2008.
Okay. I guess, the question is about large, systemically important financial institutions. We didn't write it down like you said. Not very far from it. But anyway, I take your point. Here, Lynn?
I think the response actually reflects the perception of supervisors. Until such time that we're assured that all jurisdictions are effectively implementing the standards and have adequate measures in place, we always have that doubt that in the end, the government support, the taxpayers' money will always figure into this resolution cases. So.
Thank you. Arthur?
I agree with everything that's just been said there. I think when you compare where we are today to where we were in 2008, it's just a completely transformed landscape in terms of resolution of these firms. And so I think you'd have to acknowledge that whatever probabilities you assign to any of it, they are higher than they were then, much higher than they were then, that we could do a resolution without the kind of support that we needed and or that we provided in 2008. And, people like to say that it wouldn't work in a crisis and so forth. It sort of gets to the magnitude. But, if we had all these tools in place prior to 2008, the magnitude of the problem is likely endogenous to how the problems are handled. So you could picture that, at least in the U.S., things may have unfolded differently. If Bear Stearns in March of 2008, if it had the loss absorbing capacity and a clean holdco and stays on derivatives contracts, I don't think we would necessarily have had to handle it the way it was handled, which created expectations that Lehman would be handled in a different way. And so you could have seen the progression just unfolding differently if these tools had been in place.
Right. I think that the point made by Mark is clear. It depends very much on the jurisdiction. If we think that the political environment is relevant, certainly political environment is not the same across jurisdictions. But in some jurisdictions, actually, will be penalized politically any sort of public support to a failing public institution. In other jurisdictions, with the contrary, will actually politically penalize the idea of sort of bailing in the creditors of those institutions. So I think it's probably an important element to bear in mind. This leads us to the end of this 20th anniversary conference. Over the last day and a half, I think we have had extremely stimulating discussions. I have enjoyed very much the lively debates in the different panels and also the keynote addresses. We have touched upon a number of key issues for financial regulators and supervisors and for the financial industry at large. We are very pleased at the FSI that we are able to celebrate this 20th anniversary precisely with what the FSI stands for, which is basically to promote open debate and dialogue based, obviously, on analytical thinking on key issues which are very relevant for all of us. Many inspirational points have been made, the keynote addresses, in the different discussions and debates in the panels. We have taken due note of all of them, and of course we'll reflect on them, and for sure you will see that in our forthcoming activities, actually we'll make use of some of the comments and points and ideas that actually were raised in the discussions today and yesterday, so that will be reflected in our events, certainly in our FSI Insights publications, and potentially also in our FSI Connect tutorials to be used in our training activities. So it has been a great honor for the Financial Stability Institute and the Bank for International Settlements to share this special occasion with all of you. So please accept my sincere gratitude for taking the time to travel to Basel to participate in this important event for us. In particular, of course, I would like to thank Governor Lesella, Governor Inves, Luis Pereira, President Knott, and Yves Mersch for sharing the different panels. all the panelists, as well as our keynote speakers, Howard Davis and Professor Amit Seru, for their very inspiring remarks. Indeed, this event has been in the making for almost a year, so I must, and I'm happy to record my sincere appreciation to all my colleagues at the BIS who have helped organizing this conference, from meeting services, printing, communications, corporate security, and of course, all the FSI staff who were directly and intensively involved in the preparation of this conference. So it's clear, and I appreciate very much the words of congratulations that many of you have actually conveyed to the BIS and the FSI. Certainly, we are convinced that we have a quite an exciting journey in front of us. So I would like to invite you, all of you, to basically to join us in trying to support the important work conducted by supervisory organizations and regulators around the globe in the years to come. So thank you very much. Please have a good and safe flight back to your homes. But before that, of course, join me for lunch outside as usual. So thank you very much.